This class discussion, which occurred in February 2013, begins by noting the then recently started G20 and OECD BEPS project to deal with the base erosion and profit shifting conducted by many multinational companies. This approximate 23-minute discussion covers roughly how a supply chain structure accomplishes three corporate tax goals. The high success of such planning was one of the principal motivations for initiating the BEPS project. These three corporate tax goals are: first, minimize taxation in countries where operations are conducted and/or sales are made. Second, avoid current taxation in the multinational's home country by avoiding any CFC rules that it has. For the U.S., these CFC rules are typically referred to as subpart F. And third, to earn profits within a company resident in a tax haven country having low or zero taxation.
BEPS project, and that stands for base erosion and profit shifting. Multinationals who are operating in many countries, they have been very, very successful at doing two things. Number one, paying very little tax in the country where they operate. They're manufacturing in Thailand. And very little tax in their home country. In this case, the United States. And if you are successful in business and have a lot of income, but you're not paying any tax, or you're paying very low tax in the country of operation, country maybe where you're selling into and so on, and you're paying little or no tax in the home country, that you must be putting a lot of profit somewhere. And that somewhere is very often nowadays tax haven. This is something that the multinationals have been very successful at. Okay, so in brief, how is this done? How are they achieving this and getting the OECD and many governments all excited about this? Again, I don't remember whether I mentioned it, I think I sent around an email with the links for the two UK Parliament hearings. I assume that you guys have better things to do than to watch this, but it's indicative of how the UK feels cheated. The UK feels cheated that Starbucks, has hundreds and hundreds of shops, coffee shops in the UK, and pays very little UK tax. Google is selling billions of dollars of advertising to UK businesses effectively, and is paying very little UK tax. Or Amazon, selling books and all sorts of things from a distribution center inside the UK. Again, very, very little UK tax. This is from the standpoint of the countries of operation, whether it's Thailand, whether it's the UK, they're concerned about this. To sum up what I've said so far, the multinationals have been very successful at minimizing taxable income and taxes locally where they operate. And they have been very successful at not paying tax in the home country. And they have been successful at stockpiling cash and earnings in various tax havens. I saw an article just yesterday or the day before saying that Apple is up to $137 billion of cash. the bulk of it is outside the United States. So now the question, well, gee, how do they do these things? That they pay little tax here, they pay little tax here, and they stockpile it over here, whether it's Bermuda or Cayman Islands, some tax-efficient country, as I like to call it. Most others, of course, would call it a tax haven. In order to legally place profits in a tax haven company, that tax haven company must be doing something. It must have something of value which allows it to earn income. If it had nothing of value and no no activities of its own and nothing of value, then you would say under good transfer pricing principles that no amount of income can be left here. So the first question is, how do we put something of value in there? And what types of things of great value are easily movable? If ABC has certain manufacturing technology, certain product IP, so to speak, can it transfer that IP to this one? Certainly can. If it transfers, based on our discussions last week, well, gee, how's it going to get there? Exchange for shares? Is it going to be just a contribution to capital without any capital being issued? Is it going to be a sale? Is it going to be a license? How are we going to get it there? We might decide that the way we get it there is through to make it simple, let's just say we'll get it there by way of sale. So ABC has formed Y, a company in a tax haven, and Y has a lot of money, maybe from capital contribution when it was initially capitalized, maybe from a loan. Could be a loan from ABC, could be a loan from a third party. But in any case, ABC and Y enter into a sales contract or a license for a lump sum, for example. And the rights that are transferred could be the worldwide rights. They could be the rights for all countries, but not including the United States. You can have an arm's length sale of intangible property. Is it easy to value that intangible property? Probably economists looking at this could come up with, a broad range. ABC would probably try to support a value toward the bottom of that range because, of course, if this is a taxable sale, ABC will receive taxable income as a result of that sale. ABC is willing to accept that because they think there's going to be so much benefit in the future. Further, very often, the transfer is at a time before the overseas business is really developed very much. When did Google transfer its intellectual property to a Bermuda company? They did it, as I recall, back in 2003. All of you used Google back in 2003? Certainly it was not worth, back at that time, what it is worth today. The idea, whether it's Google or whether it's ABC or whether it's a pharmaceutical company that maybe transfers IP with regard to a pharmaceutical item that maybe they think is going to be big, but it hasn't finished its clinical trials yet. The idea, try to transfer it before it becomes terribly valuable. And transfer it in a taxable transaction. So ABC has some taxable income. It pays some tax. Now the IP is down here. And again, we'll talk about this more next quarter, but if the R&D people are up here, those R&D people have to support Y because their efforts is improving this IP. So Y is going to have to pay ABC in some way, and there's various ways they can do it. Y will have to pay ABC for those R&D activities to keep the IP up, to improve it, to complete it, whatever. So we end up with IP which becomes more and more valuable over time here in Y. Now, let's say we're talking about a product, again, whether it's a computer, whether it's a cereal, whatever it is. The IP's down here. The manufacturing is going to be here because this is where the manufacturing facility is. If you remember back to our discussions earlier in the course, or at least in the podcasts about contract manufacturing, Y, who now has all of the intellectual property needed for Y to manufacture this item, Y can arrange with X down here to manufacture essentially as a service Y. This becomes, in a sense, a processor, just doing a service. This one owns the IP. So the compensation to X is not a compensation which would be the price applicable to a branded product. The compensation is, you're performing a service for me, I'll pay you, for those services. If they're routine, I'll pay you just a routine, simple amount. If they're really very complicated and take a lot of expertise, well, I'll have to pay you a bit more, but I'm paying you for a service. So the pricing reflects services, not the manufacture of a branded product with a lot of technology in it. So that means that X is just making, at the end of the day, after it subtracts off all its expenses, it's making a relatively small amount. This one, let's say, now sells into another country. That could be a related party, could be an unrelated party. Sells into another country, and the bulk of the profit is in here. The bulk of the profit is in here. The R&D was done here, the manufacturing is done here, but we're minimizing the amount of income related to the R&D effort. We're minimizing the amount of income related to the manufacturing effort. And if this company is related, we're also going to minimize through limited risk distributor agreements and so on. So this is the supply chain concept. Well, transfer pricing as a concept is part of this. Yeah. Yeah. Well, I mean, there's a lot of aspects that or a lot of our environment that allows this to work. And the reason I say transfer pricing is only a part of it is that the effort to try to put certain activities and certain assets into certain legal entities, that itself is not transfer pricing. It's just, we can choose if we want to have ABC sell to Y certain defined IP. It has nothing to do with transfer pricing, the decision to do it. Okay, now we're going to sell it. We need a price. Okay, transfer pricing helps us determine a range of reasonable prices. Similarly, we decide that X will perform the service of manufacturing the asset, the product for Y. How much, that decision is not transfer pricing. But how much Y pays for that service, yes, we have to look at transfer pricing rules to figure out how much those services will cost.
From this point, the discussion moves from discussing minimization of tax in the country of operations or where sales are made to the question of why the tax haven company's income isn't currently taxable in the U.S. under the U.S. Controlled Foreign Corporation rules, which are typically referred to as subpart F.
Yeah, why doesn't subpart F catch this? Again, we will go back in the next, in 529 in the spring, we'll go into this in more detail. But to make a long story short, if this one, you've heard about the check the box rule. Yeah. Okay, if this one is a corporation, is treated as a corporation, but maybe this one down here is a disregarded entity under the check the box rules. Is there anything in subpart F which says that simply because you have a zero tax rate on certain income, that it becomes subpart F? This is a good example where the IRS, the U.S. Treasury and IRS came up with this great idea to simplify things. This was in the mid-1990s. Came up with the check the box concept. And intellectually, it is a good idea. But the way it was implemented, it created the ability to play games, in a sense, with this that is just unparalleled. And the IRS quickly realized that, gee, we shouldn't have done this so terribly, broad. And they came out with regulations back, maybe 98 or 99. I remember my timing correctly. And they would have stopped all this. But the business lobby, who were so excited by this, made so much noise that Congress essentially said, you can't do this. And the Treasury backed down. And there's never been a restriction on this. So it's a very, very broad thing. What's the concept of subpart F income? Okay, foreign-based company sales income. Y is manufacturing an item in Thailand, and let's say this one's a related company also, and it's a disregarded entity. And it, both X and this one, let's call this W. So from a U.S. perspective, because of this check the box thing, the Y is not just this little box here. Y is all of this. Y is under this fiction, this make-believe, this pretend, which check the box is. Y is a company incorporated in this tax haven, but which has real operations, real assets, real manufacturing activities, real sales activities in these various places. Now, what's the definition of foreign-based company sales income? Income that's earned by a CFC, where the point of origination of the product and the point of destination are outside the country of incorporation, and a related party is involved. Do you see any related party here if Y is considered under this fiction? The first thing is it foreign-based company sales income? And the basic definition is point of origination, point of destination, outside the country of incorporation, and a related party. There's no related party. Now, there is a branch rule. And yes, you have to figure out how the branch rule applies. But they have been very successful at this. The other big thing that allows this, let's say that this one here is not a disregarded entity. But let's say that X has borrowed money from Y, or there's a license of technology, and X is paying a royalty. So it could be interest, could be royalty. There's a specific exemption for these kinds of things in 954C6.
Those royalty interests which X pays to Y, they can be deducted by X.
Oh, absolutely. Absolutely. That's very much part of this thing. It's a deduction for X within Thailand, and it reduces Thai tax, but, and it pushes income into the tax haven, and the U.S. doesn't pick it up as subpart F income because of this 954C6 rule. This is a pretty short section, but it basically says that royalties and interest that are paid by X that's operating in its country, that when received by another related company, will not be foreign personal holding company. Will not be foreign personal holding company income. There's a few conditions, but it's normally not a problem. The biggest condition is that it's a temporary provision. It's every 2 years they've extended it for another 2 years. The results of this is that the U.S. companies have been extremely successful at avoiding subpart F. Of course, it can have Y declare a dividend, but the recent history is that the Apples, the Googles, the Microsofts, they have not needed that money, and they just leave it here. I don't know whether you were in the room at the time, but I saw an article yesterday that Apple has $137 billion of cash. So they're very successful at this. And, of course, they choose never to pay a dividend from Y, so there's no home country tax. The U.S. is a deferral system, so they just don't pay the money back. But if you have a territorial system, then, yes, they do pay the money back to the home country, and it's under the territorial rules generally is not taxable. So this is, let's say, roughly the supply chain structure, which is putting into a tax haven company valuable intellectual property so that they can arrange their affairs for this one to be the risk taker, have the entrepreneurial risk and benefit of gain, risk of loss inside this company. So the risk and the intellectual property very often